the $65 billion Wall Street Ponzi scheme, the Bernie Madoff story. For years, he was seen as the gold standard of Wall Street, a man whose name alone inspired confidence. Bernard Madoff wasn't just another investor, he was a pioneer, a market maker, and a former chairman of NASDAQ. To many, investing with him felt less like a risk and more like a guarantee. His clients ranged from billionaires to charities, all drawn in by one irresistible promise: steady, reliable returns in a world of financial uncertainty. But behind that promise was a deception so massive it would shake the global financial system. For decades, Madoff wasn't investing money at all. He was simply moving it around, paying old investors with new funds in a carefully maintained illusion. When the scheme finally collapsed during the global financial crisis of 2008, it exposed a $65 billion fraud, one of the largest Ponzi schemes in history. This is the story of how it happened, why it lasted so long, and what it teaches us today. Let's watch. 1. The rise of a financial powerhouse. Bernard Madoff began his career in the 1960s with ambition and sharp instincts. He founded Bernard L. Madoff Investment Securities, starting small but quickly growing into a major force in the financial industry. What set him apart was innovation. Madoff played a key role in the development of electronic trading, helping modernize how stocks were bought and sold. This positioned him at the forefront of financial technology and earned him respect among peers. His influence only grew when he became chairman of NASDAQ. This role elevated him from a successful businessman to a trusted authority in the financial world. To outsiders, he represented stability and expertise. To insiders, he appeared connected, knowledgeable, and trustworthy. This reputation became the foundation of everything that followed. People didn't just invest in his firm, they invested in his credibility. 2. The secret behind perfect returns. Madoff's investment strategy was marketed as sophisticated and consistent. Clients were told he used a split-strike conversion strategy involving options and hedging techniques. It sounded complex enough to discourage questions, yet believable enough to inspire confidence. In reality, there were no such trades taking place. The returns shown on client statements were entirely fabricated. Instead of investing money, Madoff deposited funds into a bank account and used incoming investments to pay existing clients. This is the essence of a Ponzi scheme. Money flows in, but no real profit is generated. As long as new investors keep joining and withdrawals remain manageable, the illusion can continue indefinitely. What made Madoff's scheme unique was its consistency. While markets rose and fell, his returns remained steady. Ironically, this should have raised suspicion, but instead, it reassured investors who were desperate for stability. 3. The power of exclusivity and social proof. Madoff didn't advertise his services aggressively. Instead, he created an aura of exclusivity. Access to his investment fund often came through personal connections, referrals, and elite networks. This approach made investing with him feel like a privilege. Wealthy individuals, hedge funds, and even charities competed for a spot in his circle. The perception was simple. If you were accepted, you were part of something special. This exclusivity created powerful social proof. When influential people trusted Madoff, others followed. Financial advisors recommended him, institutions invested with him, and entire communities placed their wealth in his hands. It wasn't just about returns, it was about belonging. Investors felt secure not only because of the numbers, but because of whom else were involved. This collective trust became one of the strongest shields protecting the scheme. 4. The warning signs everyone missed. Despite its success, Madoff's operation showed multiple red flags. Independent analysts noticed inconsistencies in his reported returns. One of the most persistent voices was Harry Markopolos, who repeatedly warned regulators that Madoff's strategy was mathematically impossible. Markopolos even submitted detailed reports explaining exactly how the fraud worked. Yet these warnings were largely ignored by authorities, including the U.S. Securities and Exchange Commission. Investors also overlooked obvious concerns. Madoff acted as both the investment manager and the custodian of funds, an unusual and risky arrangement. Additionally, his firm used a small, unknown auditing company instead of a major, reputable one. So why didn't anyone act? In many cases, it came down to trust and complacency. People didn't want to question a system that seemed to be working in their favor. The fear of missing out often outweighed the instinct to investigate. 5. The collapse during the 2008 financial crisis. The beginning of the end came with the global financial crisis of 2008. As financial markets crashed, investors across the world faced losses and uncertainty. Naturally, many turned to Madoff, hoping to withdraw their funds. But the scheme depended on a constant inflow of new money. When withdrawals exceeded new investments, the system began to fail. Madoff no longer had enough funds to maintain the illusion. In December 2008, under mounting pressure, he confessed to his sons that the business was one big lie. They reported him to authorities, leading to his immediate arrest. The revelation stunned the financial world. What had appeared to be a stable, reliable investment was nothing more than a decades-long fraud. The scale of the deception, estimated at $65 billion, made it one of the largest financial scandals in history. 6. The human and financial devastation. The impact of Madoff's scheme was catastrophic. Thousands of investors lost their savings, including retirees, families, and small business owners. For many, the losses were life-altering. Charities were particularly hard hit. Organizations that relied on Madoff's funds for their operations were forced to shut down, cutting off support for countless beneficiaries. The emotional toll was immense. Victims experienced anger, betrayal, and despair. In some tragic cases, the financial losses led to severe personal consequences, including mental health struggles and even suicides. Beyond individual losses, the scandal damaged trust in the financial system. Investors became more cautious, regulators faced criticism, and the reputation of Wall Street took a significant hit. This wasn't just a financial crime, it was a human tragedy with far-reaching consequences. 7. Lessons from the largest Ponzi scheme in history. The story of Bernard Madoff offers critical lessons that remain highly relevant in today's financial world. First, consistent returns in volatile markets should always be questioned. No investment is completely risk-free, and unusually stable performance without a clear, verifiable explanation can be a major warning sign. Markets naturally fluctuate, so perfection is often unrealistic. Second, transparency is essential. Investors must understand how their money is being managed, where it is going, and who is responsible for overseeing it. Independent audits, regulated custodians, and clear reporting structures are not optional, they are necessary safeguards. Third, regulation must be both effective and proactive. The failure of the U.S. Securities and Exchange Commission to act on early warnings allowed the fraud to continue for years, highlighting the importance of accountability in oversight institutions. Finally, trust should always be balanced with verification. Reputation, no matter how strong, should never replace proper due diligence. Even highly respected figures can engage in deception. These lessons reinforce a simple truth: financial awareness is not just helpful, it is essential for protection and long-term security. Outro. The rise and fall of Bernard Madoff is a story that extends far beyond financial loss. It reveals how trust, perception, and the human desire for security can be carefully manipulated. Madoff didn't rely solely on complex financial tactics, he relied on belief. He understood that investors wanted stability in an unpredictable market, and he created an illusion that seemed to provide exactly that. However, his downfall marked a turning point. It forced regulators to rethink oversight and exposed serious gaps in systems meant to protect investors. It also pushed individuals to become more cautious, encouraging deeper research and skepticism. before placing trust in financial opportunities. The legacy of this Madoff investment scandal is clear. Knowledge is one of the most powerful tools an investor can have. Awareness helps separate genuine opportunities from dangerous illusions. While schemes like this can damage confidence, they also provide an opportunity to rebuild it stronger and more informed. In the end, resilience comes from learning, adapting, and never relying on trust alone without verification. Let us know in the comments what you think about the $65 billion Wall Street Ponzi scheme Bernie Madoff. And don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.